Good afternoon, guys. Today is March 8th, Friday. Hope you guys are well. Markets are still doing well. And I think I keep getting messages from people on Twitter asking when the market might go for a little bit of a break, given that we've had so many good weeks, the market going up. There's no news to really take it down. You might get 1 day or 2 days like we did on Tuesday. I think it was Wednesday, where the market went down 100, 200 points. But long term, this trend is still up until it breaks the 21-day moving average to the downside for a couple of days and stays there. I don't see this being a down market. We're still in a secular bull market. Bull markets don't last for like a month or 2 months. They take a while. So don't expect, you should expect a little bit of a break, but not a correction in a serious sense for a little bit until you get the confirmation on the 21-day moving average. Okay, so one of the stocks that showed up on my radar is Bill.com. The reason I think it showed up on my radar was because it actually had a power earnings gap down. Usually, when a power earnings gap happens up or down, it goes on to my watch list. And if it power earnings gap, meaning that after earnings, it gaps up and creates a candle that is very, very significantly green with a large body, then I wait for a flag or a pennant to see if it move up. That's usually a bull flag pennant, if you will. And then if the power earnings gap goes down, then you usually wait for a bear flag, which is usually or a bear pennant, where the flag actually moves up. So it bounces off, goes off a little bit. So let's say this is earnings on March 8th, for example, has a big red candle that you see with a white body, not necessarily just a white wick, just a white body. And then the stock tries to move up over the next few days, then you know that's a flag that has been created, and then it's going to go more down. So that's one of the reasons why Bill.com showed up. So let's start taking a look at what the company does, how they do it, what they do it. Again, we're going to go a little bit of the background about what the company does. I usually like to know what companies I'm investing in. Otherwise, I'm not investing in the company. If I don't know enough about the company, I don't see the point in go to the fundamentals, much less go into the technicals, if you will. Okay, so Bill.com is a invoicing, billing, payment management, accounts receivable, and accounts payable solution for small and medium businesses. They have roughly about 500,000 companies that are using their solutions, small businesses. And they make money in three ways. Number one, they sell a software solution for you to be able to manage your accounts payable, accounts receivable. That's one. The big amount of money they actually make is in the transaction fees off of the payment that is made easily to you or you make to others. And the third way they make money is on the float cash. Now, what happens is the money comes in, they hold it for a couple of days, and then they make the payments going out to somebody else. That is called float, and they will make money on that float cash as well. So that's how Bill makes money at a high level. Now, they compete with people like Intuit, which does a lot of people's books, accounting and bookkeeping, but they compete with a lot of other players as well. So I thought we'll take a quick look at this company, see what they do, and go from there. Now, if you look at small, medium businesses, there are millions. In some estimates, there are between 20 million to about 70 million worldwide small businesses that could be a potential target for Bill.com. Now, small, medium businesses, they need to receive money from customers, so they will invoice a customer, get money from them, and manage through the process. Usually it's services business, like legal firms, accounting firms, things like that. But any business really could benefit from accounts receivable. And they also pay their suppliers, and they pay employees and so on and so forth. But mostly when they pay businesses, which is pay their suppliers. So you get money from customers, you may pay a certain amount of money to the suppliers. That essentially is the financial operations requirement. Spend management is when employees use their own money. Employees use the company money to be able to buy things for operational needs. For example, books, pens, paper clips, things of that nature. And then payments are typically what you would make to utilities or any other requirements, if you will. So a lot of small businesses for the longest time use a lot of paper-based processes, but most realistically, they don't use paper-based processes. This is actually an incorrect term. They use Excel spreadsheets. They map all of this work on Excel spreadsheets. That's the biggest problem. If you automate this financial operations, it gives you a single, simple dashboard. Again, dashboards are not really a big thing that small, medium businesses care about. They care about getting paid very quickly. They care about paying their suppliers as slowly as possible so they can keep their cash flow more solid within the company. And they can make and receive payments as well. So Bill.com Bill.com is this financial operations platform. You can pay your suppliers, you can get money from your customers, you can send and receive payments, you can budget, and you can manage your cash flow as well. And that gives you a lot more visibility into where money is coming. And if you want to be able to, if you're a mid-sized business and if you want to be able to have some of your employees go ahead on a trip, for example, to meet a customer, you want to manage where they spend money and not go reckless with their spending, you can manage that through spend management from Bill itself. Okay, so the typical invoicing and the receiving process is customer places an order. That's the first time. And usually what happens is in many cases, now this is a small, medium business that gives you terms as opposed to a restaurant, you're a consumer. This is a business. So that's the big difference. Consumer goes in, they pay the cash, they take the goods and they're gone. Business is usually like credit. So a business, for example, let's say in some cases, you look at legal firms, they actually ask you for a deposit upfront, which is a retainer fee to make sure that they are not worried about spending their time and then not getting paid. So what typically happens in a lot of cases is customer would pay money or put a deposit, but in this case, a credit is approved in a lot of companies. So if you're a customer to a business and you want to be able to get some credit to be able to buy some stuff that you need for your own stuff, let's say, for example, you are a bakery and you have the needs for flour and you place, say, $10,000 worth of flour every month. You will go to your flour developer, supplier, distributor, and tell them, hey, give me some credit. I want to be able to buy it and I'll settle it by the end of the month. So credit approved. Then after that, when you buy, let's say $1,000 worth on the first week or $2,000 worth in the first week, an invoice is sent and then they will go ahead and manage the collection. So for example, if your invoice is sent, you have to pay for it. And some part of that collections is managed. For example, sometimes customers go bust, they won't pay for it, disputes are common. Sometimes, for example, a customer might or a supplier might bill you for $100 when the actual payment was $1,000. If there's debt that is uncollected, that's written off, but the payment is processed and the reporting is handled. That's typically the process that they would go through. Now, accounts payable versus receivable. Accounts receivable is when you get money from customers, money that businesses are owed to you. You're selling this product or your service to your customer and you give it to them, giving it to them on a credit, you get an asset. Accounts receivable is an asset that's recorded in your books. That means you need to get this money from the customer. And then the accounts receivable increases your company's cash. Now, until you get the actual cash, it's still an asset. Once you get the cash, it becomes cash flow, then it becomes cash and becomes a profit and so on and so forth. Now, transaction is caused by selling goods on credit, which means, for example, if you sell this product on credit, you actually record that as revenue that is coming in, but it goes into accounts receivable. When you get that money, it actually is recording revenue. Okay, cash flow comes in. On the other side, accounts payable is when you owe it to suppliers. You bought it, for example, you bought a good, you bought a service, you bought someone comes in and installs, for example, an air conditioner for you. You bought that air conditioner on credit, and you would pay them on a monthly basis, or you pay them in 2 installments, 1 installment, whatever the case might be. It is a liability. It sits on your books because you owe money, and it decreases your cash position. Okay, every SMB to a large extent, when they say small, medium business, Bill.com primarily caters to about 500,000, little less than 500,000 customers. Most of them typically tend to be companies that are mid-sized. There are small customers, but small customers just churn. That's a big problem with the SMB market. Whether Intuit, whether it's HubSpot, whether it's Klaviyo, all of these sell to SMBs. You will find a big problem when you're investing in companies that sell to SMBs is just the fact that they have a lot of churn. So you got to watch that metric, churn metric, very carefully. In a lot of cases, they just use Excel. A lot of small businesses just use Excel. It's not paper-based process. This is a little incorrect. They do a lot of manual processing as well. And knowing where you are from a cash position, visibility-wise, is very difficult for a lot of these mid-sized businesses. So you could be selling a lot on credit, not collecting enough, you wouldn't know. That's a big problem, right? Or if you go ahead and give a lot of credit, but you don't collect on time, you're still not making enough money to be able to pay for your bills. That's a big problem. Those are the challenges that typically small, medium businesses face. I've known a lot of people that didn't even know that they were not profitable until they looked at their books more carefully to see when their collections were happening. They were getting customer payments in 90-day credit terms, but paying their suppliers in 45 days because their suppliers were a little bit more aggressive. So that becomes very, very difficult. Okay, so there are there are about 20 million realistically in the US itself, companies that are small, medium businesses. Because of the churn, it goes up and down, but about 20 to 25 million is what the number I've seen. Whereas Bill.com saying that they're SMB, sole proprietor, which includes sole proprietors, probably I can understand it's about 34 million total. Their spend on SMB software alone is about 75 billion, and the B2B payment volume is about 28 trillion dollars. So this is trillion with a T. Okay, and that global opportunity is about 70 million companies and roughly about 125 trillion. So technically, they could go after the SMB software spend market with their software solution, and they also get a portion of the payment volume, which is anywhere between 2% to about 5%. In some cases, it could be more, but usually it's about 2 to 5%. Okay, so what they do, once you extend credit to a customer, then you can invoice them, you get paid, and then you reconcile your payments. If you want to pay the customer, you will reconcile the payments based on you receive the money, you approve the payments, you pay, and then you reconcile. So reconciliation happens both on accounts receivable and also on accounts payable. And then the spend management, the one on the blue on the right-hand side, is when you want to be able to do operational research, operational spending for running the business, but it's not part of your goods, soft cost of goods sold, if you will. Okay, so Bill.com offers an integrated financial platform for mid-sized businesses, small businesses. You want to get accounts payable done, you want to get accounts receivable done, you want to manage spend and expense management, and you give financial tools, planning, budgeting processes, things of that nature. So mid-sized businesses, very, very relevant. Small businesses, they typically stick to QuickBooks. Okay, just to give you context, Bill.com has 500,000 customers. Intuit by itself, depending on who you talk to, is anywhere between 10 million to about 15 million overall customers. But 2.5 million customers are actually active QuickBooks Quicken customers. Just keep that in mind. So a lot of people, this is a very fragmented market. Everybody uses their own custom solution. Still, a lot of people use Excel paper-based mechanisms. Bill.com also partners with a lot of people. Primarily, they partner with financial institutions because they need to do the credit facility, manage the receivables, etc. They also manage or they partner with accounting firms who do the accounting for bookkeeping, if you will, for being able to manage the accounts receivable and accounts payable. Okay, so who do they target? They target primarily SMBs and mid-market. Micro businesses, you'll find a lot of them use FreshBooks. They use Xero. They use Wave Payments. They use a lot of different opportunities. Payoneer, Pay.com. There's a ton of opportunities in the micro business space. In the SMB, the mid-market space is where Bill.com really thrives. So realistically, I'm talking about the serviceable addressable market. If you remove that portion of it, they have 500,000. They have an opportunity to get to 10 to 15 million realistically within what I believe is their target market. Why do people choose Bill over others? I had a chance to be able to talk to one customer who actually uses Bill, and the key part is they've been around for a long time. They've been either relatively easy to use. Their payment terms and the fees that they charge for the transaction fees are reasonable, comparable to most of the other people, not necessarily less expensive or more. But their go-to-market strategies work with accounting firms, work with the accountants. So typically a small medium business, this is what they go through, right? They will start the business. Let's say you're a solo person, you start the business, you get a little bit bigger, SMB business, you'll typically go to QuickBooks. So you go most likely to an accountant. You might manage it yourself, but most likely you go to an accountant and say, can you manage the books for me? You manage the books, it gets a little bit better, and the accountant comes back and says, hey, listen, I can actually help you optimize this a little bit better. You have multiple choices. Some businesses by default use Intuit QuickBooks. Others will go, actually, you're a mid-sized business, why don't you go to a Bill.com? So their go-to-market primarily works with accounting firms who push the product over across to the customer, help them manage it, and the accounting firm will get a little bit of money for a referral fee, if you will. So they win because it's specifically for financial management. They don't do HR. So small, medium HR firms, small, medium businesses using HR solutions, they probably use something like a Workday, and even smaller than that, there are a few other solutions. Money movement rails. So rails is essentially a term that is used for being able to tell you that you can get onto the platform for buying and selling and paying payments infrastructure. It's usually called Rails, if you will. They have a good go-to-market. A lot of companies come self-serve with them, but really partnership with accounting firms is where they make a lot of mid-sized businesses, and they create a network of some sorts. When I was at Ariba, this was almost about 20 years ago, the big advantage with Ariba was once they got the big customers to come on board, then they got the suppliers. So it becomes a network. The customers come on board and they start saying, I'm going to buy on Ariba, and they're going to use the software. And then because of that, suppliers come because they want to make sure that the customers buy it. So that creates a network effect. The more buyers come in, the more suppliers come in. The more suppliers come in, the more buyers come in, if you will. There are about little less than 500,000 SMBs that use their system, about 45.8 million members, which is actual users, employees within those companies and users. And the total payment volume is about 300 billion. Remember, there's about 28 trillion in the US going through SMBs itself. And they believe that they can grow from 300 billion to roughly about 3 trillion in a good amount of time. Okay, the business model, they make money in three ways. I already explained this to you guys. I'm going to go through it again. Subscription revenues for the software itself. This is the per user pricing. I think they will have to change this. This is going to be the big challenge for a lot of the companies in the SaaS space to move away from the software as a service subscription user pricing model to more of a consumption model. And the consumption model essentially means you will charge it by number of transactions done as opposed to number of users. So they will have to change it at some point in time. I'm just telling you that this is going to happen. So it's going to be monthly or it's going to be annual rate. And then feature and functionality, I think this is going to change. 20% of the revenue that is coming from subscription revenue will have to change to more of a consumption model as opposed to the user model. Transaction revenue is typically based on the interchange fees. So anywhere between 2 to 5% is the flat fee that typically they would charge for the customer. That's the core part of the revenue, making up nearly 86% of the revenue. And then float revenue. Now, what happens is when customers send money to somebody or they receive money from somebody, that money stays in the bill.com account. They could process it to your bank and so on. But then they use that float money to be able to make cash as well. Very similar to what Robinhood does, just to give you cash, give you context, for example. Robinhood makes money multiple ways. Number one, they make money in transaction fees, the difference between the spread on your crypto buying price versus the selling price. Number two, they make money when they sell your payment for order flow data across to the big brokerages and also to other people, that's hedge funds that need the data. The third they make money is, let's say, for example, you have $10,000 in your Robinhood account, and you don't want to actually go ahead and invest it right away because you don't find anything interesting. You're keeping it in cash. Let's say 3,000 of that in cash. They can use that float money to loan that money to other people, make interest on it. That's called float. That's how Bill.com also makes money on the money that is kept within their account. So total revenue grown very, very quickly in FY23. They've gone to nearly about $1 billion, 65%, but they're slowing growth. One of the things that happened, Bill.com, in the last conference call that I didn't hear it. I read the conference call transcript, was that one of the statements that was made by the CEO was we're seeing a little bit of a challenge with the SMBs being more specifically judicious in their spend. I'm paraphrasing, but that's essentially what he said. So that essentially had a big sell-off of the company. It was decent after earnings, but as soon as the conference call was done, everybody got a little bit of a jitter saying, hey, what the hell happened? This means like their customers, they're tightening their belts, and that dropped the stock in their price. We'll go through that when we go through technical analysis. Year over year, they've grown about 22%. So growth is definitely slowing. This is 20% growth. Core revenue, which is a combination of two things, remember, subscription fees and transaction revenue grew about 50%, almost 49%, and then year over year grew 20%. So float revenue seems to be growing much faster than anything else is. Okay, adoption, nearly about 473,000 customers, so 500,000 customers are using it, 9% growth in customers. So new customer growth is not as much, transaction growth is increasing, and the subscription revenue is somewhat increasing. So I would like to see more their net revenue in terms of, I want them to be able to show me the breakdown of their NRR, their net recurring revenue and subscription fees. Is that going up or down? Meaning that once a customer comes in, are they significantly increasing that? I don't think they are, which is why they're not sharing it. Otherwise, they would be very specific about here's our NRR and subscription revenue. What is really happening, I think, is when a customer comes in, they're locked in. It's very difficult to move out of permitting payment solution once you have it in. And once that happens, if your company does better and better over time, your transaction revenue increases because the number of transactions increases. The transaction processing, look at that, actually has increased 23%. Go back here, 22% growth, 23% is because of transaction revenue. This is not growing very, very high. The number of new businesses is not growing significantly. It's about 10%. It's good growth, but not significant, not growing at 22%, obviously. The transaction process is going much, much higher, and the payment volume is growing higher. They've had good growth. We'll go through that when we go to the fundamentals, but about 30 million in 2020 to about 390 million, 10 times. They've grown nearly 10 times, 69% growth in just about 14 to 15 quarters. So very good execution overall. So overall, if you look at a lot of the companies, let me just summarize for you. The back office with most of these companies tends to be very, very manual. It's not paper driven, it's email. When they say paper, they mean email, they mean Excel spreadsheets. That's quote unquote paper. So it's not like people are sitting and writing in a piece of paper and passing back and forth. Excel spreadsheet, emails tend to be a lot of the use cases. It's very manual and very cumbersome. And it's, typically people make mistakes with their invoices. People send the wrong invoices. People collect less revenue sometimes than required. And there's lack of information about what is happening in this whole thing. And so the questions that typically customers have, which is CEOs of these companies, proprietors of these companies have, is a lot of the questions that you look about before, right? Is it within the budget? Can we pay this later? Can we pay with deferred? Things of that nature. It's become much easier to be able to make this completely available online. So their financial system, in a simple way, if you're a buyer of solutions, helps you be able to manage your payments. If you're a supplier, it helps you be able to get your customers to pay for you. That's essentially what it does. It's a powerful two-sided network. So the more suppliers come in, so let's assume you are a customer of Bill.com and you send an invoice to somebody. That customer sees, hey, this is an invoice that I got from Bill.com. It's how easy it is to pay them and how easy to get it, and then they might adopt them too. So it becomes easy. And similarly, if you are a user of Bill.com and you tell somebody, hey, I'm going to pay you through Bill.com, the supplier gets to know and they say, maybe I should adopt it as well. So there is a little bit of a network effect that could be very beneficial for Bill. Okay, so they also have a good corporate card spending solution. Let me give you an example of this. So if you're a mid-sized business and you want to be able to manage what your employees spend on travel or just what they would call petty cash previously, you use it for a whole host of different things. You can manage that better with Bill.com. A lot of small companies do this right now. Marqeta can do this, Brex does this. A lot of companies actually do this, more on the startup side, but Bill.com allows you to do that as well. They've done a couple of acquisitions over the years. So Bill has done a good job of acquiring one or two companies, but they've mostly stuck to their basics. They've acquired a company called Invoice to Go, gives you an easy way. So this is a construction company, for example, if you're a builder or if you're a build to spec builder and you have to keep invoicing your customer to be able to make them pay you on time, you would go ahead and use it on your mobile phone, make it easy for you to be able to go ahead and send your invoices, get paid quickly, and pay your suppliers as well. So that's what Bill.com, they acquired Invoice to Go. So if you look at Bill.com overall, they typically, if I have to summarize for you, they work with a lot of accounting firms. That becomes a big portion of how they get their customers. They go direct to SMBs as well, but a lot of money, a lot of business they actually get from accounting firms. They use capability. They obviously do a lot of direct marketing to these businesses, but a significant portion of their business, I know, comes from accounting firms. They compete with people, obviously, once they get to the bigger size customer, then they would compete with Oracle, NetSuite, QuickBooks, etc. But they also compete with a lot of small players, and they also partner with a lot of the banks themselves. It's purpose-built, so it's an accounts payable solution, accounts receivable solution, payment services, which includes spend management, which is not put over here, but that's a big portion of it as well. Above and beyond that, some of the important services that I've heard from people that they really like is the treasury services. Once you get to about $20 million to $50 million mid-sized business, treasury management becomes important, which is cash that exists in your bank. You don't want to just keep it in cash. You want to be able to earn interest on it. You want to be able to use it in a very strategic manner. Those are things that Bill.com can help you with. That's what their platform essentially looks for. If you look at what typically SMBs use, they typically will tend to use a lot of bookkeeping and accounts receivable, getting paid, invoicing solutions. And then after that, they get to payroll and HR solutions. And then after that, accounts payable, spend management and order management. So I think what you will see, which is an interesting question that I had for myself, where would they grow? Now, there are two ways to grow. Obviously, they can get a lot more customers, go from 500,000 to about the total addressable market. Although they claim is about 34 million, I think realistically they can get to about 1 million to 2 million customers, in relatively short order if they continue to do what they're doing. Besides that, they can make more by more payments. They can add more services. The more services with selling existing customers is likely going to be, if you look at where the acquisition might be next, it might be in a payroll space. There's a lot of companies in the payroll space. So Paycom, PAYC could be a target. They could merge together with them, or they could merge with a whole host of other smaller players in that market. And what are the barriers? Some people to accounting, using accounting or accounts payable, it typically tends to be the processes are very complicated for a lot of these businesses. It's not so much that I think actually in some cases they'd be very extensive and sophisticated. It's just complicated because there's a lot of email. One person knows it. They don't do enough of it. They keep too much of it in their head, or they keep it in a spreadsheet. That's essentially what stops a lot of people from adopting. What does the accounts payable process look like? Businesses make the purchase, vendor issues the invoice, the bill will be received and then reviewed. They will approve it and then they'll pay it. That's simple enough process, but obviously it takes a lot of more steps. Summary, about 470,000 customers use Bill.com, mostly mid-sized businesses. They have about 5.8 million network members. They're growing very fast to about $1 billion in FY 2023. Their growth rate for 2024 is expected to be in the 20% range. 20 to 22% range. They've dramatically lowered their growth rate in terms of revenue. Gross margin is still very, very good, about 80%, 70 to 80%, and they have a net dollar retention rate of about 103. But remember that 103%, that's why I wanted to break down, but I'll go through it in a little bit more and try and get a better sense for where they are. So that's Bill.com, just to give you a little bit of a better sense. Now, what we're going to do is now go through our 5-step process and see what we like about this, what we don't like about it. Okay, then. This is Bill.com. I'm going to go first to the financials on an annualized basis. Okay, 64 million in 2018 and 1 billion. Oh my goodness, this is beautiful. 60%, 40%, 50%. So this, I think, oh, this was good. This was phenomenal. I think this is COVID boost. That's what happened. COVID, just that was going as a decent business, just completely jacked up because of COVID. So this is just the tailwinds of COVID. They've done a very good job of COVID during the COVID timeframe to grow revenue. So 64 million to $1 billion. That is beautiful. This is a company doing about 7 billion in market cap, about 7 billion in market cap with about $1 billion in revenue. So reasonable valuation. We got to look at it a little bit more detail, but this is very good. But the only problem is revenue has slowed down dramatically for the rest of the year, or next year's revenue has slowed down dramatically. Let's look at that. Gross profit, nearly 80%, still growing at 90%. Look at this. Their gross profit is growing very, very well. So they've been able to manage their costs very, very well. And net income, they don't have net income to speak of. That's probably the challenge, but it's dropping. It grew up dramatically and then it's dropping now. And we've got to look at now from a quarterly basis. How are they doing on a quarterly basis? Oh, look at that. They were growing at 90% last year. Was it 90%? No, 60% last year to 20% a third. The growth has just plummeted. So it's gone from 150% growth in 2022 to 40% to 30%. They're going 10 points lower. So they're going to continue. They're expecting to grow 20%. So 20% on 1 billion, let's round it up to about $1 billion, right? $1 billion, 20% is 1.2 billion. They may make it about 1.3 billion. $1.3 billion is what they're going to do. And their market cap right now is about 7 billion. That's roughly about between 5 and 6 times, which is a decent valuation for an 80% gross margin company. This is very good valuation. I think the question is whether that might be challenged in terms of even getting to 20% growth. But this is a very good valuation. In terms of valuation, this is a very good company. Gross margin is still in the 80% range, and then they have to get to profitability. Man, this is useless. They actually went down in terms of did a very good job of managing their costs, and then it's starting to go up back again. That's dumb. So they got to do a better job of this, but this is not bad. Do they have enough cash? They have about 9 billion in assets. They did an acquisition, so there you go. 6 billion in cash. That's not bad at all. 6 billion in current assets, sorry, and about 2 billion in debt, very manageable. And cash flow wise, they're doing okay. So that's not a problem at all. They should be able to manage enough money coming in to service that debt. That's the most important thing that I typically look at. Valuations, 5 times, 6 times. Look at that. Even that continues next year is still going to be about 5 times. It's very good valuation. The valuation is just crushed 18 times. So look at this. This is interesting. As opposed to everybody else whose valuation has doubled, if you look at all of the last 5 videos that I've done for this week itself, the valuations have doubled even though the revenue is not. These guys in the last 1 year, revenue has gone up 60% and the valuation has gone down. So this is reasonable. I think this is a very good valuation for a company, Bill.com. 75, 80% gross margins, negative 12%. So they got to get profitable. I think if they suddenly start to show that they're getting profitable, which I think they will in the next quarter, or even show signs of growth being okay, then this becomes a very interesting company. So what did Bill.com do? Went public in 2019, very beautiful. Oh, just look at the stage 2 markup. Stage 1 consolidation all the way to April 2020, and then boom comes the COVID boom. Just absolutely, just straight up beautiful. Stage 2, this is stage 3, this is consolidation. And then after that, hello downside. This is a stage 4 markdown. You could just literally call this even still at the stage 4 markdown, but I'm going to say that it is maybe till even here. This was a markdown stage. And then after that, they did a little bit of consolidation, stage 1 markup, and then stage 2 markup, consolidation, stage 4 breakdown. They're still technically in a breakdown, but realistically, this looks like it is in consolidation phase. So I'm going to put this in the consolidation phase over here. So there are a lot of people holding the bag on this one. I'm pretty sure of that. That's why I wanted to cover the stock as well. So I'm going to remove these because these are not relevant. Just wanted to show you what this beautiful graph looks like. It looks like a Christmas tree, doesn't it? Going up all the way green, coming down all the way red. Okay, so on the long term, on the monthly chart, this is actually consolidating. It's still not out of the woods yet. It's still on a consolidation basis. So this is phase 1 consolidation. Usually after phase 1, depending on how long it lasts, as you see, phase 1 markup. I'm sorry, phase 1, and then happens a phase 2 markup. So it should come to a markup at some point of time when valuations start to get reasonable, and the valuation is very reasonable for the stock right now. So this, if they can show that they can get to a profitable stage, this is good. All right, let's look at the weekly chart. On the weekly chart, still consolidation, nothing dramatic. Actually, this is a head and shoulders. This is the head. This is left shoulder. This is right shoulder. No wonder it's going down, but it's been bouncing off of this. This seems to be a good resistance over here, support somewhere over here. I need to find it exactly, but this seems like 59 seems like a good resistance. And where is it right now? It's about 68. So it's right at that spot. I think this is getting ready. I mean, just realistically think about this as a business. Let's summarize their fundamentals. I'll give them a 7 or 8. They've got good amount of cash in the bank. They're growing at about 20% revenue compared to, of course, 150%. So this is very similar to what a Zoom or someone else has gone through, right? Zoom, Peloton, Etsy, boom for COVID, and then slowed down growth. But this has become very reasonable valuation right now. At about 5 times, and they still have a large enough TAM to go after in terms of customers. They're just not growing as fast. So that's a question really more than anything else to ask yourself. If you bought this at the 136 range, you're going, man, I want this to get back soon, which it could probably get back. Realistically speaking, right now, this is the resistance for it, this previous zone, which is the 84 zone. It's even got to make it back there. But if we bought it at 136, the chances of it going back to 136 it's going to take a little bit of a time. As soon as the market realizes the valuation is lower, then they could, but they've got to show something dramatically different in terms of acquiring customers faster and growing it faster than 22% year over year. So on the weekly chart, still consolidating, and we saw a little bit of a look at this. This is left, this is right, this is left, this is right. So head and shoulders, this is, let me just draw that out so it becomes obvious. Head and shoulders, but seems to have finished that consolidation phase. I'm going to take this, I'm going to put it here, and then on the weekly chart, this, even this, head and shoulders, and it goes down. But it's been consolidating. That was the weekly chart. Okay, now let's go to the daily chart. That happened. There you go. After the head and shoulders, it went down. Last earnings, it just took a beating. Earnings were okay, but they said, we're going to slow down. This was a 65% growth phase, and then look at that, just absolutely tanked. So there's a big gap that it created. I'm going to take off a lot of this stuff just to show you. This is just education. Head and shoulders, down she goes. All right, this is a big gap that is created. It tried to close that gap over here, 86 back again. So now it is formed. So this is the head, this is the shoulder, not exactly head and shoulder, so I'm not going to call this head and shoulder. So where's the support and resistance now? Let's find that portion. This is definitely a bounce point. 60 seems to be a bounce point, 59, 60, whatever you want to call it, right? Every time it gets to that point, although it did get a little bit lower here in the 51 zone. So this is still going to have to hold. This is a couple of touches over here. It tried to move up for false breakout, and then now it's breaking out again. Getting to the point where it is reasonable in terms of it's definitely trying to move up. But on the long-term basis, remember, this is still a consolidation zone. So, and the resistance for it is in the 80s. it's going to have to break through this with a dramatically good flare if it does show good revenue. So next revenue, so previous revenue, two quarters ago revenue, big gap down from the 80 down to the 50s. Yeah, just absolutely crashed. Then after that, went to the 51 range, did a good job of moving up back again before the next earnings. And after the next earnings, most recent earnings was on February 8th, just absolutely went down again, another big gap down. After the gap down, what did it do? This is what it did. Didn't do anything really. This is neither a flag nor nothing. This is just I'm going down. Look at that. So you could call this a flag, bear flag, but I don't think so. It's just consolidating right now. It's trying to move out of this big zone. I'm going to remove that portion of it just to make sure that I can see it more carefully. It's trying to move out of this zone. I think it could. And then if it gets to the 71, it could easily get to the 84 range before next earnings. So just what happens, it takes it back and then goes back up again. So I think before next earnings, which is expected in May. So 3 months from now, 2 months from now, something like that, March, we're in March, April, May. Before May, this is going to the 84 range. So if it is going strength right now, if you think that's all it's going to do, I actually think it's actually going up. I suspect it's going to make a move like this back again to test this zone to the 80 and see if that is the opportunity. And when the earnings comes out, it's more likely going to do something like this. Like this, it's going to do something like, again, this is my prediction, may not happen. And then on earnings, whether if they show a little bit of a, hey, we have a good opportunity, move back up again, then it breaks through this barrier and goes to the 80 zone. If not, this thing is just going to crash again, come back to test this 50-60 zone. That's what I think about Bill.com. Thank you very much. The RSI seems okay, still in a good zone. MACD is curling up. Yeah, so this is going up, guys. This is definitely going up a little bit. It may get to the 69 zone fairly easily, 70s at least. And then between 70 and 80, there's a large gap. It's going to slowly meander its way through. This is not, after the big moves of the last few years, this has been more of a steady move. So I expect this is going to take about, look at this, previous earnings to this earnings, it moved up and then moved a little bit down again. I suspect it's going to do the same thing again. Try to touch this base as much as possible, get to the 80 range, wait for earnings, see if it is going to move a little bit down and just flatten up, curl a little bit. Depending on earnings coming out well or not, it might then move up or might go back and retest the 50s. Thank you very much for watching. Let me know what you think.